Chapter 2 is Introduction to Securities Market. Primary market, everybody knows you have public issues, you have IPOs, which is your initial public offering. Then you have something known as FPO, further public offering. Now, what is it? What is FPO? Typically, a company which has already gone the IPO route may require further money, and they may want it from the general public. In that case, they can issue an FPO, or it is known as further public offering. That is, second time they can go to the general public. Now, why would a company want money again? It could be for expansion purposes. It could be they want additional capital assets. They want to create capital assets or buy some machinery, etc., etc., at a bigger level. Also, when they want to redo its capital structure. Means what? Let's say I am a businessman. I started by taking debt. Okay. Loan I did not want to do because it would have made slightly difficult things for me. I am ready to issue some bonds and get some debt money with me. I'm ready to make those coupon payments and the final payment. Now, it's been a couple of years that I've started business. It's doing well. I don't want to continue with this commitment of paying coupons. So I want to retire, that is, close all the debt which is outstanding for me. One simple way is go back to the equity markets for funding. So I go back to the equity markets. I've already been there once, so I can't issue an IPO again. So I will issue an FPO. Get the money from the people, give clear of my debts, and that would be the end of things. Okay, so that's your FPO for you. Rights issue, existing shareholders have the right to subscribe for further shares of the same company at discounted rates. So the prerequisite for a rights issue that you should be an existing shareholder. This comes with a premium. So I'm getting a discount, I'm not getting it free. Private placement. So when I go to a select group of persons, but this is not a rights issue or a public issue, then it is known as a private placement. Typically, it's nothing but wholesaling to institutional players. It could be in the form of QIP or preferred allotment. Now, private placement minimum offer has to be made to less than 200 persons. So if I make a private placement to 200 or less people, for FPO, no, you should not be existing. So there was a question here, sir, for FPO, should we be existing shareholders? The answer is no. You can be a fresh shareholder also. So I was talking about 200 persons. Offer made to less than 200 persons is called private placement. Private placement now may or may not be listed on the stock market. So if it has to be listed on the stock market, it has to get the SEBI approval, and all the terms and conditions of SEBI should be satisfied. But they may choose not to go for SEBI approval and not to list it on the stock exchange. Still, private placement is possible. Preferential issue, we have a detailed slide later on for preferential issue. Now let's just touch base. When it is given to a list of issuers who have convertible securities, so I put forward my issue or my stocks to a select group of investors, something like a private placement. I can issue shares or convertible securities, which is in convertible debentures. I can do that. But the difference between this and private placement is this requires to not only comply with various SEBI regulations, but also with the Companies Act as well. Okay, so that is the difference between a private placement and a preferential issue. QIPs, qualified institutional placements. It is a private placement only, but I have identified certain category of individuals which are known as QIBs, qualified institutional buyers. I just give it to them. QIBs could be financial institutions, mutual funds, banks, etc., etc. SEBI has defined certain criteria for them. So whenever we look at it, we'll go through the details of it. Bonus: existing shareholders are given bonus. This is in lieu of no consideration. That is, there is no money taken when the bonus is given. A bonus is an issue. A bonus issue of 1:3 means that for every 3 shares you hold, you'll get 1 share of bonus. You can ask your question in the chat box. Okay. Onshore versus offshore holdings. Anything which is created in India is onshore, rest is offshore. OFS. OFS is an offer for sale. It can be an IPO, it can be FPO. Either ways it can be. So OFS. So it is slightly different from the normal IPO or FPO which happens initially, wherein here the shares are not fresh shares. So whatever is done in OFS is not fresh shares. It's existing shares in the market. So the existing shareholders sell their share which has been allotted to them. Normally what happens is, typically you have the promoters or big investors. They put in big amount of their personal money. If the stock takes off very well, they will want to liquidate their positions and encash the profits. Now, one way is they sell the stocks in the secondary market. But if they do that, what will happen? The stock price will start going down because of the rumors. Okay. And that is something which they also don't want to do. If they're selling it in the secondary market, that news comes in, that will create a panic in the market and there'll be panic selling which will happen. So what is the alternative available? They, in consultation with the company, would open a OFS, would do an OFS, and that is where they would give the stocks officially to people, and then in that case, the emotions in the market are not altered. Also, there's no fresh issue of shares. The share capital does not change here in case of an OFS. Now, the government of India does these disinvestments. Everybody's aware of that. So whenever they do that, the shares held by the government in PSUs are floated into the open market, and this is a classic example of OFS. Okay. ESOPs, when an existing employee of a company buys shares in that company, that's ESOP. FCCB, what is this? This is foreign currency, usually dollar denominated debt raised by companies in the international market. They have the option of converting into equity shares before maturity. So what happens here is that I have bought FCCBs. So I will get dollars. So denominated, I'll get dollars in the international market associated with that. And I can convert them as convertible debentures into equity shares before the maturity of that particular product. Depository receipts. So what is depository receipt? Financial instruments that represent shares of a local company but are listed and traded on stock exchanges outside India. So whenever an Indian company creates a financial instrument and it is traded on the stock exchange outside the country, that is known as DR. DR is usually issued in the foreign currency, so usually it is dollars. There are 3 types of DRs: ADR, GDR, and ADR. American Depository Receipts, global and European. Anchor investor. Now, anchor investor is somebody who's qualified institutional investor who makes an application of 10 CR or above in any public issue, according to SEBI guidelines and regulations. Okay, so he's making an official statement that I will apply for 10 CR in your particular company. So this concept was introduced in 2009 by SEBI. The volume and the value of the anchor subscriptions serve as an indicator that of the firm's soundness. Now, multiple advantages here. One is the promoter is assured that in case his or her IPO goes unsubscribed or lower subscription is there, the anchor investor will come in and take care of everything. But this is also a source of strength and confidence to other investors. Because if an anchor investor is ready to put in 10 CR, then obviously I can put my 10,000, 10 lakhs, etc., etc. Secondary market. So you have the OTC market and the exchange traded market here. So let's look at the market participants and their activities. So obviously you have the stock exchanges, depositories. What are depositories? Depositories are something which holds securities of investors in a demat or an electronic format. You can open a depository account with the depository through a depository participant. CDSL, which is Central Depository Services Limited, and NSDL, which is National Securities Depository Limited, are two examples of depositories. Depository participant or the DP. A DP is an agent of the depository through which it interfaces with the investors and provides depository services. Investor-led accounts in securities are managed by the DP. So remember, this question can come that who manages investor-led securities? So they are managed by the DP. Who manages the company level accounts? They are managed probably centrally from the depository itself. Depository appointment is done through, the DP appointment is done through SEBI. Then you have public institutions, scheduled from commercial banks, banks operating in India, etc., with the approval of SEBI, certain guidelines, custodians, etc., can comply with the regulations and become a registered DP. Trade members or brokers. So these are basically who do buy and sell. AP. AP is very, very similar to the brokers, to the agents of the brokers. So the way brokers have agents, authorized persons have authorized persons are agents of the brokers, and they are registered with the respective stock exchange. APs typically are the hands and legs of the brokers, wherein that they ensure that the spread and the reach is there. Custodians. Custodian is an entity that is vested with the responsibility of holding funds and securities of its large clients, typically banks, insurance companies, foreign portfolio investors, etc. They maintain securities and funds in the client's account, collecting benefits or rights during the client, accruing to the client in the respect of securities held, keeping the client informed of actions to be taken and or which have been already taken on the portfolios. So custodian is essentially somebody who is holding the funds on the behalf of the client, nothing beyond that. Clearing corporation. So you have the clearing corporation, which acts as a counterparty to all trades which exist, and they ensure that there is no counterparty default which is there. It can be a part of exchange or a completely separate entity. Clearing banks. So every member has to maintain a book of records with the clearing bank. Certain minimum balance has to be maintained. Merchant bankers. So these are the one-stop shops for any company when they go the IPO route. So if I have to give an analogy between merchant bankers, so merchant bankers are something like your event managers for a marriage or a function. You leave it up to them. They take care of the flowers, they take care of the decoration, lights, food, music, everything, interior decor, and all that stuff. So similarly, merchant bankers will evaluate capital needs of the issuer, structure an appropriate instrument, get involved in pricing, manage the entire process, issue securities, stay connected with the all the parties which are there, stay connected with the regulators, and so on and so forth. They engage and coordinate with the intermediaries such as registrars, brokers, bankers also at the same time. Next is underwriters. Now, for all of those who are from an insurance background, underwriting there and underwriters here mean something different. Let's understand what it is. So, underwriters are intermediaries in the primary market who undertake to subscribe any portion of the public offer of the securities which may not be bought by the investor. So, if IPO gets oversubscribed, the issuers are more than happy. But if it gets undersubscribed, then where will that money come in from? So here the underwriters play an important role. They say, okay, we will manage the show. We'll ensure that we buy the securities which are not getting sold. So they give the comfort of securities and do not elicit any demand from the investors. Now, there's something known as hard underwriting and soft underwriting. So what is hard underwriting? Hard underwriting typically means that before at the initial stage only, the underwriting norms were existing, and the underwriters decided to subscribe to that particular portion of the overall IPO valuation. Soft underwriting is basically after a certain period has passed, then only they come in. Okay, so they evaluate the situation and basis that they take a call. Institutional participants, mutual funds, pension funds, insurance companies, alternative investment funds. Yes, you already had a look. I don't have to go through it again. And FPIs, or the foreign portfolio investors. So an FPI is an entity established or incorporated in India that proposes to make investments in India. So any entity which is established outside India and wants to make investments within the country, within India, that is your FPI. Registration with SEBI is mandatory. Okay. So these are the two things here, which is the alternative investments and the FPs. Then you have something known as investment advisor. So whatever we do in course of our business, that is not something which we are supposed to do. Okay. So that is the role of exclusively investment managers. So any advice of any sort, any risk return profiling has to be done. So all of that is managed by the investment advisors. EPFO is allowed to invest 15% of incremental deposits in equity and equity related schemes. NPS obviously can't be discussed in a minute. It's a huge topic in itself. Regulated by Pension Fund Authority, Regulatory Authority of India. So PFRDA. NPS schemes have been able to invest in equity shares, corporate bonds, and the government securities. So as I said, NPS is a detailed chapter. We'll not be able to cover it here. Institutional participants. Now, one very common word which you see in the market is something known as family office. What is it? A family office can be defined as an ecosystem with which the family builds around itself to manage its own wealth. So if you see us, typically what has happened is our grandparents used to stay together. Parents started staying separately in their own apartments. And now if you look at us, a lot of us also want to go back and live in a joint family. So there are pros and cons both ways. Now, typically where businesses are in the family itself, they're taken care of by multiple partners in the family. In that case, you need a legal and a financial framework around that entire core team which works to optimize investments and returns. So that is how the concept of family office came into picture. So they identify the needs of the family or key family members. They look at lifestyle goals, charity, estate planning, and do an entire exercise. So that is where family offices come into picture. Corporate treasuries, now all the big companies need money for working capital, etc. That money is available with them. Now they need to deploy it for it to generate some return. First and foremost for them, it is on now what do they do in corporate treasuries? They do debt management and capital structure management. So what is the best source of financing at this point in time, and so on and so forth? They have a look at it. The focus is on debt management and capital restructuring. The important responsibility is to take long-term funds and minimize costs. So whatever is the duration of holding for a corporate treasury, they will try and take the money for the entire territory. Okay. So nowadays, the corporate treasuries also have a challenge of generating certain returns every day. So either you do it in the morning or in the evening, you have a thing which is getting done. So with this, we end chapter number 2.